Thanks, Shane, and thanks again, everybody, for joining us this morning. All right, so just maybe in a minute, a bit of a recap of what we did last week. So we started with our RAC engagement, and we started working through the engagement and team setup, looking at the engagement acceptance and continuance, the new engagement predecessor auditor review. We looked at the audit firm's independence, the individual team member independence declaration, the accounting framework, competencies of the engagement team, and we finished with planning material last week. What we're going to do next now is the audit type selection, and let me just go through the questions related to 10.15. Now, as I have mentioned before, at the moment, the kind of procedures that are built into RAC, it's just an audit at the moment. We do hope to get a review built into this as well, but that's probably only going to be in next year sometime. The process there is really going through what has been already put into RAC and comparing it with what the requirements are for a review, and then going and deciding whether there's enough crossover between the two that it makes it work and worthwhile to do. Otherwise, we will rather go and redesign something like we have our attorneys' trust methodologies and things that are separate, and that might be the case. The next question that you're asked on 10.15, and this is where the 4 different sized companies come in with a RAC, and you'll see if I hit this drop down, I'm left with a large, a medium, and a small. At the moment, no RAC micro is available, but if I quickly flick over to my micro client, and I'm going to go to that very same drop down, and you'll see now micro is an option here. Okay. Now, the reason that RAC micro was not initially visible is we've actually built a few controls into the background to make sure that before you select RAC micro as your file option, we want to make sure that you are definitely dealing with a low-risk client. We don't want clients coming back to us and saying, well, they decided on RAC micro, and as a result, their audit didn't go so well. And you'll see that there is this RAC micro tab at the bottom of the screen, or it's one of the sheets available in this workbook, and this lists a number of considerations that we would like you to make before using RAC. And we're talking about the PIS score of the entity, the fact that this must be a voluntary audit, it can't be a statutory audit, all these things trying to push it towards being an owner-managed business rather than a high-risk client. Now, that's not to say that an owner-managed is not a high risk. Obviously, there are various things in an owner-managed that could also make it high risk, and there could be risks involved in accepting that audit. But unless all of these questions are answered with a yes or are not applicable, that RAC micro option actually doesn't become available in this drop-down list. So if you get to this point and you do want to use RAC micro, please remember that you need to go and fill in that questionnaire on the next sheet in order to access RAC micro. If you don't, it's not going to be there. If you're not bothered with RAC micro, then you don't need to worry about the sheet. The sheet's only there to be completed if you want to use RAC micro. Okay. So just in terms of what does it mean, and I'm going to flick back to my medium client quickly. What does it mean? What is small, medium, large, and micro all about? Now, on the one hand, what I want to say is that the difference in those questions is not necessarily about the size of the client necessarily. What we're looking at more is the risk profile of your clients, and that's what we're focusing on. So the large, medium, small, and micro is more about actually the size of the audit file at the end of the day and what we're going to do with this audit file. Now, I often say if I wanted to, I could go and audit SAB Miller, massive multinational client. I could do it with RAC micro. We haven't taken away the audit quality. It's going to be a heck of a lot more difficult to fill in because, for instance, there are 4 working papers within RAC micro, and I'll show them to you probably next week, where there actually aren't any questions on the working paper. All it is a number of paragraphs where you can go and document, for instance, your knowledge of the business. So the whole idea behind RAC Micro is that you're still getting the quality in terms of looking at the risks and things as we go through. You'll see more and more of that. But what we're adding onto it is just reducing the amount of workload that's involved based on the assumption that we're looking at, as I said, this low-risk audit. So just to distinguish between large, medium, and small, when we originally got the working papers to start developing RAC from Protect a Partner, if any of you are familiar with ISA 315 and have read it recently, it's a great bedtime reading matter, you will see that it is in ISA 315 that our management assertions are listed. And at the end of the day, when we audit, we're auditing the assertions that management have given us. In other words, they say to us that the financial records are complete, accurate, transactions exist, assets exist, so on and so forth. So those are the assertions of management. And there are actually 14 assertions listed in ISA 315. However, in close reading of ISA 315, what ISA 315 says is you don't need to go and stipulate all 14 of these assertions. You can summarize those assertions. And in fact, the IFAC guide for the audits implementation of ISAs for the small and medium audits actually reduces it down to 4. They speak about 4 assertions in their IFAC guide. We've actually gone with 7 as a summarized set of assertions. So that is the distinction that you will see when going from a large client to a medium client, and that's purely in terms of the number of assertions that we're going to be dealing with. Right, so with a large, you will be looking at 14 assertions when you're assessing your risks. With medium, you're looking at 7. And when we look at the next working paper, I'll go through that with you in detail, what those assertions look like. So then we had a large and a medium, and that's great. And one of the decisions that we made with RAC was that we were going to start following what we call a cycle-based audit approach. So we're not going to audit revenue on one audit program and trade receivables on another. We want one audit program that covers revenue and trade receivables. Now that makes sense. It is a business cycle, and certainly what I found when I was in audit practice, you'd have one clerk who does creditors, you have another clerk who does expenses, and they end up going to the same poor clerk at the client, their credit controller or whoever it may be, and the one is asking for invoices, the other one is asking for creditor statements, and they're basically asking all of the same questions about what happens in this business cycle, which can lead to frustration, and it does lead to some sort of inefficiency, because instead of one person getting a good understanding of the entire cycle, the entire business process around a particular business cycle, you've got 2 people who are trying to focus on a portion of it and maybe not getting the big picture, which can lead to maybe risks being missed or issues being left out or forgotten, or you think somebody else is dealing with it. So that's why we looked at a cycle-based audit approach within RAC, and as we go through the training you'll see how that's implemented. However, when we start getting to a small client, and this is where small comes in, we start saying, look, it's no longer effective to have a trade receivables and revenue section. Let's say, for instance, in a property company, because that property company has 12 invoices a year. The tenant pays on the 1st of every month, so there's no debtors. Why do I need to go and audit a separate cycle, look at business processes around the cycle, document my understanding of the business cycle? It's not going to be applicable in such a small entity. And that's where what we do is we actually, instead of cycle audit programs, we go down to basically just a balance sheet audit program and an income statement audit program. So you're left with 2 audit programs in the entire file. You still have some additional audit programs, so for journal entries you will still have an audit program and any other special risk items that you may choose, but ultimately you're auditing on 2 audit programs. So it's great for 1 or 2 people on the engagement. It's a very small entity. We talk about very low risks. We're not looking for risky companies to be audited on small, not because you can't, but just because it's going to be more difficult to go through the processes and the steps. So large to medium, we cut out the number of assertions, and medium to small, we cut out the number of cycles, and we're basically left with a balance sheet and an income statement audit program. Okay, if you have more than 10 line items on your balance sheet, probably don't select small, because once you start getting, well, in fact, our audit programs are limited to 10 cycles on each audit program. Otherwise, it just gets way over the top to try and complete. Then you're going to need to rather go for a medium if you've got that many components sitting in your balance sheet or income statement. But we'll have a look at that again as well when we get to 10.20 and look at the difference between the different sizes there. Okay, so that's basically it. This is the decision that you need to make. We do to some extent try and reduce the amount of work between large, medium, small, sorry, I should say the number of questions, but it is very difficult to take questions out of a planning working paper, because what if that one key question was actually the important one for your small business that you're busy auditing? So we try and summarize, we try and make things easier, and we will show you as well as we work through some documents what those changes and differences are that you can expect. Now I just want to show you, if you have a look here for instance at 10.15, you'll see that the working paper here is telling me that this document is actually required, 10.15. It's saying document required, yes, detail level, moderate, okay? And the green blocks to the right gives you the opportunity to kind of override the selection that's been made. So let's say, for instance, in this case, 10.15, we're saying it needed to be complete on a moderate level of detail, but you know the document, you actually want more detail. You can increase the level of detail on one of these working papers if you so desire. You can never downgrade the level of detail. You can only ever increase it on any one of these working papers, and you can't make a working paper go from required to not required, but you can make it go from not required to required again. So if you just look at the options where it says yes, the only option in my drop down is a yes. Just to show you then, for instance, 11.15, we were talking there that it says moderate. Have a look when I select large, you'll see it automatically shows now as full. So it's now a full detailed document. So if you're wanting to see what impact these selections are going to make, you can go and see that in fact there are 5 documents that end up being listed with moderate. So there are 5 documents that we somehow summarize slightly when we go from a large to a medium. And in fact, most of the other documents don't ever change. So for instance, planning materiality, we can't reduce the amount of detail that you put into your planning materiality. You have to do that calculation the same, irrespective of the size of the client. Okay, so that is 10.15 and the audit file type selection. I'm going to leave this one as medium. This is my medium file. And we will now go and have a look at 10.20. Okay. All right, so now 10.20 is the identification of audit sections. Now the purpose behind this document is for you as the auditor to go and make a decision, what components am I actually going to audit at the end of the day? Which of these are going to be part of my audit file? In other words, which items are going to be allocated to my cycles? Now within RAC we're up to 27 different audit programs that we made provision for within the working papers. But let's say you take a RAC small and you've only got 2, a balance sheet and an income statement. Then there's this huge overhead in terms of excess documents that you need to go through and mark as not applicable, which you don't even need. So at the moment, if I open up my audit programs, I don't have audit programs in place except for my journal cycle. That's the only audit program that I sit with at the moment. Okay, so the purpose behind 10.20 is to enable you to go and choose these items, design your cycles, and basically be able to progress with the audit and decide what audit programs you're actually going to have at the end of the day. Now, what the standards tell us is that we need to get sufficient and appropriate audit evidence over all material balances. So the very first thing, and the reason why we've already calculated materiality before this point, is we needed to know what balances are actually material. Okay, so in the first column, after the balances are portrayed, we have a quantitatively material calculation, and this automatically will tell you yes or no whether this is an applicable component. Well, in fact, it'll tell you whether it is more than materiality. Okay, so the first item absolutely is material. There's 139 million cost of sales. That's definitely material. I think if you recall, our performance materiality was 4.5 million from our session last week. Payroll expenses, definitely material. Then we get to depreciation. Depreciation is 581,000, and it's telling me that it's not quantitatively material. Okay, but where there is a balance and it is not quantitatively material, in other words, it's not more than 4.5 million, it does highlight the cell for me to give an indication of whether this is maybe qualitatively material, even if it's not quantitatively material. Now let's just go and consider something like this line item, depreciation, 581,000, it's not material, but are you really going to be able to audit your PPE effectively if you don't have depreciation being audited? At the end of the day, with PPE, you're going to audit it anyway. So I would go and say that this is possibly a qualitatively material item, and I go and say yes. Okay, other expenses also material. Just want to scroll down to the balance sheet items quickly. Check cash and cash equivalents, for instance. It's telling me there as well, it is not quantitatively material, but I certainly know that cash and cash equivalents is qualitatively material, and I do want to include that in my audit. Scroll further down, and we have loans to and from shareholders. It is material, so it does tell me it's qualitatively material. So wherever either it is qualitatively or quantitatively material, you'll see that it is highlighting the question, is this applicable to the audit? If I say no to revenue, for instance, it's going to highlight in red, and I spoke last week about red cells indicating an error. We can't not audit revenue. It is material. We have to do it. Okay, so on the one hand, where it's yellow, you probably are going to have to say yes, otherwise you're going to need to give some very, very good reasons why you're maybe not auditing that, but we didn't want to formularize it, and this also comes back to what we're maybe thinking in terms of our review, where some more of these items might be able to be skipped. Okay, I'm also just going to scroll down to my balance sheet quickly and mark the applicable items here. And I just want you to have a look as I type a yes into, for instance here I've typed it into inventory. Two things changed. Firstly, there is a yellow cell that opened up on the right hand side related to estimates, and I'll come back to that, and it also is already giving it a section reference. And this is some pre-population that we did. We did go and try and design some of those sections for you in the background, so that you don't need to go and every time go and allocate the cycles yourself. It is going to pull through pretty automatically, and it's going to align it to a section that's in alignment with where the lead sheet is going to be sitting. Okay, trade and other receivables, I'm just going to go through and mark these other items as yes. And then I get to my loans to and from shareholders. Now with loans to and from shareholders, it could be a debit balance, it could be a credit balance, and it changes, and sometimes it's a mixture of the two. Okay, so I'm going to say here that it is applicable to the audit, and I want you to notice that the section reference doesn't get a number, it just gets highlighted yellow. And the reason for that is because it could be either. This is one of those that we haven't automatically gone and allocated for you in the background. This you need to go through and allocate yourself, and we'll get to that in a moment. So now we've decided which items are applicable to the audit, but I want to ask a question about something like investment income. Now, what do you do when you sit with an instance like this? You've got 16 Rands worth of investment income sitting on your income statement. Now, 16 Rand is definitely not material quantitatively. Is it qualitatively material? It's a fairly, I don't know, can you call it a grey question related to whether it could be, depending on the nature of the entity. Maybe if you know that the balance should be a lot bigger, you could say, hey, listen, this is qualitatively material, sorry, get mixed up with the terminology, and we need to go and actually do something about this. But in a lot of cases, it's like a little bit of interest for maybe those 3 days where your client had a positive balance in the bank account for the year. And we can go and say that it is not qualitatively material or quantitatively material. And as a result, we have the option here now within RAC to go and say, you know what, no, this is not applicable to the audit. What that means is I will not have an audit program which asks me to do anything about investment income. I will not have any procedures. It's not going to feature in my audit anywhere, except for one final location at the end of the audit. And we have this completeness of component section, which we'll get to towards the end of the training. And in this working paper, we go and look for these little balances that we maybe said are not applicable to the audit, and we go and just confirm their completeness. If you think about it, if that balance is supposed to be 0, that's the maximum overstatement that you can have for investment income, is that it's 16 Rand overstated. That's not material. It's not going to impact my financials. But if that balance should have been 16 million, so it is understated, it can definitely be materially understated. So from a methodology approach, we've said it cannot be materially overstated, but it can be materially understated. And therefore we want to look at completeness, and that's what 70.20 is all about. Having had a recent discussion with somebody who's involved with reviewing files and having a look at the results that URBA come back with in terms of their reviews, very important tip that I want to give all auditors here. So if you've been fading away or gone to look for a cup of coffee, please listen to this. URBA is of the opinion that if you do skip a line item like the 16 Rand investment income and you say you're not going to audit, they don't mind that you don't audit it. However, what URBA are saying is that this line item, this balance, must then land up on your overs and unders schedule at the end of the day. And this is something I heard literally in this week. So if I've done any RAC training with you in the past, I would not have mentioned this before. And we're certainly going to look at a way to pull that in for you into our summary of identified misstatements so that it will automatically be transferred. But if you are skipping any balances for whatever reason, whether it's in RAC or in other audits, please make sure that any skipped balance, immaterial balance, actually does land up on your overs and unders. Now, in a case like this, the 16 Rand, it is actually less than my trivial misstatement threshold. So I would be of the opinion, for that reason, I could skip it because it's a trivial amount. I'm not sure what URBA's interpretation of that would be, but I certainly don't think they could fail you for not putting the 16 Rand on there. But maybe 1.6 million, which is not material in the case of this client, but doesn't necessarily need to be audited from a methodology point of view, that I would certainly make sure lands up on my overs and unders. I can't say I necessarily agree with it. I just did want to point it out to all of our users to be aware of this, so that if they do this on their audits, that they go and do put it on your overs and unders. So that's a nice quick tip for anybody. If you've got an URBA review coming, maybe there's something to just double check in your files to make sure that you've complied with that. All right, so we've now gone and marked which items are applicable to the audit, and we now need to go and consider estimates. Now, I will deal with it in a lot more detail next week when we look at the document 12.70, which is the ISA 240 considerations. I don't know if you can see that over there. Now, ISA 240 has got some pretty clear guidelines about fraud and management overrider controls. And one of the things that ISA 240 then talks about is actually going and doing procedures on management estimates. We need to go and understand whether management is biased in any way with regards to its estimates in the audit or in the financial statements. So what this document is doing is we've gone and listed only 2 in the income statement, but many more on the balance sheet. We've gone and listed a number of items that are potential estimates within your client. Okay. Now, revenue initial recognition at fair value, I'm going to say yes is an estimate. Determining revenue with reference to stage of completion in the context of this client, I'm going to say no, not too worried about stage of completion. This is a retail store, my little example. Don't know if I've mentioned that before. When we get to the balance sheet, we get to something like my property, plant and equipment, and you'll see that there are 5 line items listed for you to go and choose from. Depreciation, useful life, residual values, impairment and fair value. Now the only one there that I feel you could ever possibly leave out is fair value, and that's if the company or if your client does not do fair value adjustment to their PPE. So depreciation, absolutely, you need to say that this is an estimate. Useful lives, residual values and impairment are all certainly estimates. Now I just want to point out something interesting. The fact that management has not impaired their assets does not mean that management has not made an estimate. Remember, the standard requires that you look out for, and this is the accounting standards, you look out for any indicators of impairment. So the fact that management has not impaired means that based on their assessment of the indicators of impairment, there are none, but that's an estimate that there is none. So we do need to go and consider estimates. Fair value. I know a lot of guys are very excited that IFRS SME has now re-allowed fair values. We've already encountered a few support requests where people are asking us to help them with the fair values on their SMEs. But as far as I know, the new SME standards have not actually been finally published yet. All we have is an amendment document. We don't actually have the final standard. So I'd be very wary about implementing it. And also, please be aware, if you implement one portion of the new standard, for instance, the fair value of PPE, please make sure that you're fully aware of all the other amendments. You cannot early adopt only one section of IFRS SME. You have to early adopt the entire standard if you want to adopt it before 1 January, I think it's 2017. So please just be aware of that. Firstly, go and make sure that we actually get an issue date out of IFAC, and secondly, that if you do implement that, you implement everything. I'm going to say no to fair value now, there, and we go and look at something like stock obsolescence for inventory, and we've got doubtful debt provision for trade and other receivables. Fair value, yes or no? Amortized cost, a bit of a tricky one. Is there amortized cost in trade and other receivables? Now also another quick tip maybe in terms of IRBA, and if you like, please drop us a mail at support@dataprime.co.za to maybe get some more details. But IRBA are also of the opinion that you should be discounting your trade and other receivables at year end. They're from what I've heard, they're getting quite strict about the non-implementation of this discounting. We are still researching stuff from our side, so if we do get more information on that, we'll certainly pass that information through, hopefully within the confines of this training course as well. But IRBA are expecting you to be discounting your trade and other receivables. Also your revenue, the split between revenue and interest if you are selling revenue on terms. Now I know that implementation within many clients is just impossible. The other problem is, for instance, if you've got big government contracts, which is the ones that you probably most likely have to discount. Government contracts, they're not going to want to see interest on their detailed general ledger. They're going to want on their detailed ledger that you send them, their statements. They're going to want to just see the invoice amount. They're not going to care about implementation of IFRS and IFRS SME. And the drawback of that is that you then almost need to run 2 separate sets of books concurrently to try and get the right value on your income statement at the end of the day. We are just researching and having a look at that, trying to see if we can offer some guidance or ideas or thoughts on that. But IRBA are certainly wanting to look at this. And that's the fair value of revenue and the amortized cost of trade and other receivables. So also just something to think about and maybe discuss within your firms about how you're going to tackle and implement this. Okay, cash and cash equivalents at fair value. Now again, I'm going to say that it is an estimate, but if you have no foreign bank accounts or anything like that, you can probably say no to the fair value of cash and cash equivalents. Amortized cost of borrowings, I think, is quite an important one to keep considering, especially if you've got zero interest loans. There's a bit of a sneaky thing there. If you've got zero interest loans, you should also be discounting those. The only time you can't discount them or don't need to discount them if there are no repayment terms. But then I would just go and have a look at the detailed general ledger and make sure that there aren't actually repayment terms. Are they not actually in the background paying off 10 or 15,000 Rand a month, which starts giving you an indication that there is a repayment term, therefore I need to discount. Is management trying to overstate or understate the balance of that loan account on their balance sheet by not telling you what you need to know? Okay, trade and other payables, I'm going to leave it amortized cost, leave accruals, and I'm just marking a few yeses and nos so that you can see where this pops at the end of the day. Now I need to go and allocate loans to and from shareholders in my relevant section. And to do that, I'm now going to move over to the second sheet, which is my cycles sheet. Okay. So when I get to my cycles sheet, on the very top, the first thing that you will see here is that it's actually telling me the following components have not yet been allocated to a cycle. And it's telling me that loans to and from shareholders are not allocated. So the nice thing about that is all I got to do is find the cycle that I want to put this into. Scroll down, you'll see, for instance, intangible assets. There's nothing there because we don't have intangible assets, biological assets the same. I'm going to scroll down to my borrowings because borrowings is where I want to go and put my loans to and from shareholders. It's a credit balance and I want to audit it as part of that section. I hit the drop down and all I need to do is scroll through my components. There it is, loans to and from shareholders, and it allocates it. Okay. Now, if you don't like the term borrowings or you don't like the term fixed assets and investment property, if you log in as a manager or a partner, you can actually go and overwrite that cell. You can go and type your own name in there if you wish. And the reason we've made that possible is if I just scroll down to the very bottom, you'll see that there are additional other cycles available for you to go and complete. So if you want to go and design your own cycles, particularly if you're dealing with one of these small or micro clients where maybe you've got a few too many components or it's getting a bit difficult to look at the audit program, you can go and allocate a few to your own cycle that you can go and create for yourself. Give it a name, just use the drop down to select which items you want to include, and then you're going to have your own audit program with your own cycles generated when we generate the audit programs down the line. The other thing I just want to point out on something like cycles, as I've said, we have got in pre-populated items. But I just want to show you, under my trade and other payables, cost of sales is automatically allocated to trade and other payables. However, that's not always the best place to go and audit cost of sales. Sometimes, depending on the inventory system used by your client, it's actually more appropriate to go and audit it under inventory. To do that, simply go and select the cost of sales as I have, press delete. In fact, I haven't logged myself in. This can only be done with a login. So let me quickly log in, try that again, press delete, and the cost of sales goes away. You'll see immediately that cost of sales is now visible in the top gray bar. Tells me that cost of sales is not yet allocated. And now I need to go and find my inventory cycle. There's my inventory, and I'm going to use the drop down to go and select cost of sales. Okay. So that is my cycles. This bar, this gray line becomes clear, and then we know that we've allocated all of the cycles that we need to, and we're happy. Now just to quickly go and have a look at the assertions, as I said earlier, we'd have a look at assertions here. Here are the assertions that we're going to deal with in the medium client, and here they are. There's 7 plus authorization. We've just grouped disclosure together as one. And we have completeness, and you'll see that completeness is a class of transaction, an account balance, and a disclosure assertion. And that's what these items on the right-hand side are telling you. It's just telling you what those assertions are. Now the reason for this sheet, assertions sheet, is you can actually go and rename any of these items as well if you like, but just make sure that you know what you're talking about at the end of the day if you do go and rename any items. You don't want to end up with an inappropriate assertion somewhere. And in the table below, what we do, and this is what ISO 315 asks us, is you can summarize your assertions, but you need to make sure that all of the assertions listed in ISO 315 are linked to an assertion that you have chosen to use, and this little table just shows the split or how it is crossed over. Okay. Right, maybe just one other thing to comment on in terms of the components sheet that we spoke about earlier. I said you could edit the assertions. You can also edit the component name. So if you want to talk about sales instead of revenue, you're able to change that, and that'll carry through the audit program. You are also able to go and put in your own components should you wish, and that can be done in any of these cells. You'll see that they're also highlighted blue, which means that they are roll forward cells. So if you change it this year, it should appear like that next year for you as well to make things easier. And I'm not going to cover it in this training session, but there's also the opportunity to go and link amounts to the formulas in here on the lead sheet. If you do want to start using custom components, please let me know, and I can certainly help you through that process. Okay, so there's a lead sheet, there's an unlinked, that's more of a higher level training session, so we'll release some separate videos to go through that. I don't have time to do that this morning. Stratum is another sheet that appears here, and I'll go through in more detail what Stratum are when we get to the audit programs. And the last sheet in 10.20 is what we call a doc setup, and this allows you to go and add additional estimates. So if you think you need to add more of your own, just come to this sheet and say yes, you want to insert additional estimates. And what happens on this working paper is we basically make sure that there are 5 lines open for every single one of your components. And then you can go and document your own additional estimates that you'd like to put in, if you know the client well enough to go and add those things. And when you're done, just come back to the doc setup sheet, say no again, and any new ones that you've added will now be visible, and it'll then hide any of the excess sheets. Sorry, just maybe Shane, before you come on, I want to show you the what a small client looks like in terms of the cycles. Just want to go to the cycle sheet, and this is the same client. Okay, so this is what your cycles will look like when you're dealing with a small client. As I said, there is your statement of financial position. So all of these items are going to sit on one audit program. Statement of comprehensive income, same thing. All of these items will sit on one audit program once we finally generated the audit programs for you. And then you can go and design your own cycles as well. And that's available at the bottom of that sheet. Okay. 10.25, this is the engagement setup sign-off document, and this comes at the end of our basically engagement setup section. Okay. Now, what this document is intended to do is just to give you a summary at the end of the day of what has happened in the engagement setup so that you're ready to go forward. As I mentioned last week, this is a document which once we implement what we call our strict adherence, you're not actually going to be able to go any further in the audit until you have signed this document off or until the partner has signed this off. But we have not implemented that yet. We will get to that eventually once everybody is up to speed with RAC. But you do need to be logged in. You cannot fill in this confirmation block without being logged in as a manager or partner. And it's basically just from the audit partner's point of view, this is where I would say you start reviewing. Here is the information. I know the client, maybe I don't want to go through the detail about what has been going on in the engagement acceptance, but I want to just make sure that appropriate selections has been made. So if I get to this document and I see, no, well, we've said we've declined the audit, I know there's a problem, and I will go back to that working paper and I will change what needs to be changed, or I will raise review notes. But if you as the audit partner are happy, you can just go and say, yes, I confirm. There's no EQCR required. Yes, I can confirm that. Now we get to the audit firm's independence, and if you recall from our session last week, I deliberately went and put some incorrect answers in there. And it tells me that the document has been signed off, but that there are 2 incomplete questions, and that there were 4 deviations noted, and in 3 of these deviations, insufficient reasons and actions have been recorded. So it gives me that level of detail on this working paper. So again, if I'm the audit partner and I see that, it's going to ring a bell and say, listen, I need to go and do something about this. If there are deviations and there are comments, and I'm not sure what those comments are, maybe I want to go back and review, or if I understand and I know I was the one that completed it, I can say, yes, I'm happy, and I can move on. Then we get to individual team member independence, and that 10.03, we had a few clerks. You'll see that it names the clerks. Shane, I'm picking on you again this week. I hope there's not a John Smith watching, otherwise I'm picking on you as well inadvertently. And it goes and tells me for every single one of these staff members, have they signed off? So in other words, have they gone and put their initials and date in place? Are there unanswered questions? Are there any deviations? And are there deviations without valid reasons and proposed actions, and so on and so forth? Now, as the audit partner, if we get to this point where we've implemented this strict adherence, you can at this point say, yes, I confirm, and I know that the work is not complete, but I need to continue with the audit, so we will go back and address this. But at least then somebody of manager or partner level has had to go through this document and confirm that they understand where in the audit process they are. So it's almost like a little bit of a dashboard working paper that you have, and a review starting point for you to make use of. Okay. In this working paper, we haven't actually even selected the accounting framework, so that's sitting with a 0 in there at the moment. Competencies haven't been signed off. I've got my materiality at 6 million. I've got the audit type selection. I've got the entity size selected, and it does tell me that all components have been identified and allocated. Now this little yes, if this doesn't say yes, then you will not be able to populate the audit programs later in the file. And I'll come back to this later on as well. But this has got to say yes in order to populate your audit programs as well. So I'm going to say yes, I'm happy with that. And then there's a question here about a planning materiality lock. What we're saying here is in my 10.10, the planning materiality, you're actually able to lock down those values. So let's say you pulled in an interim TB, and now you need to go and import a new trial balance, but I don't want to go and recalculate materiality at this point. That was my planning materiality. We actually want to lock down that calculation there and at that point. We can go and reassess, revise materiality, and under section 18 there is a revised materiality working paper where we can go and do just that. We can go and revise our materiality. But at this point I want to lock my planning materiality. I can do journals, I can change the trial balance, I can clear the trial balance and import a brand new one.
Muted.